Hello everyone, welcome to Law Stories. In this video, we'll be seeing the statutory exceptions to income tax, that is, the incomes exempt from tax under sections 10 to 13 of the Income Tax Act. This is part 1, where we'll focus mainly on incomes exempt under section 10. Under the Income Tax Act, certain kinds of income are completely exempt from tax. These incomes are not included while computing total taxable income. Such incomes are called exempt incomes, and the burden of proving that an income is exempt lies on the assessee. There are different categories of exempt incomes. They include income totally exempt from tax, income partly exempt, exemptions for non-residents and foreign companies, and exemptions available to individuals. There are also certain exceptions relating to income chargeable under the head, salaries. There are still more points under incomes exempt under section 10, which we will be seeing in the next video. Now, let's look at incomes that are totally exempt from tax under Section 10. Section 10, Clause 1, Agricultural income. Income derived from land used for agricultural purposes is exempt from tax. Remember, while agricultural income is exempt, it may be used for the purpose of determining the tax rate on non-agricultural income. Agricultural income is defined in Section 2, subsection 1a. Section 10, Clause 2, Receipts from a Hindu undivided family, or HUF. Any sum received by a member from the income or property of the HUF is exempt. This rule avoids double taxation because the HUF itself is taxed, not the individual member on amounts already distributed. Section 10, Clause 2a, Partner's share in a firm. A partner's share of profit from a firm, where the firm is assessed separately, is exempt in the hands of the partner. In short, the firm pays tax on its profits, the partner does not pay tax on the distributive share of those profits. Section 10, Clause 10bb, Bhopal gas leak payments. Amounts received under the Bhopal gas leak disaster, Processing of Claims, Act, 1985, and related schemes are exempt from tax, unless those amounts were already claimed as a deduction earlier. This preserves fairness for victims and claimants. Section 10, Clause 10bc, Compensation on account of disaster. Any amount received by an individual or a legal heir from the central government, state government, or a local authority as compensation for loss caused by disaster is exempt from tax, except where a deduction for that loss has already been claimed. Section 10, Clause 10d, Life insurance policy receipts. Sums received under a life insurance policy, including bonuses, are generally exempt from tax. There are exceptions. Payments under a keyman policy, and policies specifically covered by Section 80 DDA schemes, are excluded from this exemption. Section 10, Clause 1015, Interest on notified securities. Interest, premium on redemption, or other payments on notified government securities, bonds. Now, let's look at income that is partly exempt under Section 10. Income of a minor child, Section 10, subsection 32. According to the Income Tax Act, the income earned by a minor child is generally clubbed with the income of the parent under Section 64, subsection 1a. However, to give some relief, the law provides a small exemption. An exemption is allowed up to 1,500 rupees per child, or the actual income of the child, whichever is lower. For example, if your minor child earns 1,200 rupees as interest income, the entire amount is exempt. But, if the child earns 3,000 rupees, then only 1,500 rupees is exempt, and the remaining amount is added to the parent's taxable income. Now let's look at incomes exempt from tax for non-residents and foreign companies under Section 10 of the Income Tax Act. 1. Interest on notified bonds or securities, Section 10, subsection 4. Interest earned by non-residents on government-notified bonds or securities issued before 1 June 2002 is fully exempt from tax. Though, interest on NRE accounts, Section 10, subsection 4b. Interest on money held in a non-resident external, or NRE, account under FEMA is completely exempt from tax. 10. Tax paid by government or Indian concern on royalty at technical fees, Section 10, subsection 6a. If the tax on certain payments, such as royalty at technical fees, is paid by the Government of India or an Indian company, and not by the foreign company, for agreements made between 1 April 1976 and 31 May 2002, the foreign company is exempt from tax on that amount. 4. Tax paid on other payments to non-residents, Section 10, subsection 6b. Any tax paid by the government or an Indian concern, other than on salary, royalty, or technical fees, before 1st June 2002 is exempt for the non-resident recipient. 5. Tax paid for aircraft lease, foreign government, Section 10, subsection 6bb. Exemption applies for tax paid by an Indian company on lease rent to a foreign government or enterprise for aircraft or engines, only if the agreement was approved and entered into before 1st April 1997, or between 1st April 1999 and 31st March 2007. Aircraft lease rent, Section 10, subsection 15a. Payments by an Indian airline company to a foreign government or enterprise for leasing an aircraft or engine are exempt if the agreement was entered into before 1st April 1997. Agreements after 1st April 2007 do not qualify for this exemption. 7. Technical fees to notified foreign companies, Section 10, subsection 6c. Fees received by a notified foreign company under an agreement with the central government for projects connected with India's security are fully exempt from tax. 8. Royalty and technical fees to non-residents, Section 10, subsection 6d. Royalty and technical service fees received by a non-resident or foreign company for services rendered to the National Technical Research Organization, or NTRO, are fully exempt from tax. Let's understand some exempt incomes under Section 10 of the Income Tax Act, which apply to individuals. First, foreign government employees, under Section 10, subsection 8. If a foreign government employee works in India under a technical assistance program between India and that foreign government, their salary is fully exempt from tax in India. However, this exemption applies only if they are paying tax on that income in their own country. Next, non-resident consultants, under Sections 10, subsections 8a and 8b. Consultants who come to India under an international technical assistance grant are also exempt from paying tax in India. Even their employees enjoy the same exemption, provided they are not Indian citizens or they are not ordinarily resident in India. Moving on, family members, under Section 10, subsection 9. If family members of such employees or consultants live with them in India, any income they earn outside India will also be exempt from Indian tax. But this is only if that income is taxable in their home country. Next is perquisite tax paid by employer, covered under Section 10, subsection 80cc. If an employer gives a non-monetary benefit to the employee, like rent-free accommodation, and also pays the tax on that benefit, then the tax amount is not considered extra income for the employer. In simple terms, you don't need to pay tax on the tax your employer pays for you. So to sum up, Sections 10, 8 to 10, 80cc provide exemptions for foreign government employees, consultants, their family members, and certain perquisites where the employer bears the tax. These provisions ensure fair tax treatment for individuals working in international or government-linked roles in India. Let's go through some of the main exceptions under the head, salaries, that is, incomes which are either fully or partly exempt under Section 10 of the Income Tax Act. 8. Leave travel concession, Section 10, subsection 5. 2. Remuneration of foreign nationals in India. 10. Allowances to Indian government employees abroad, Section 10, subsection 7. 4. Death cum retirement gratuity, Section 10, subsection 10. 5. Commuted pension, Section 10, subsection 10a6. Leave encashment on retirement, Section 10, subsection 80a. 7. Retrenchment compensation, Section 10, subsection 10b. 8. Voluntary retirement compensation, Section 10, subsection 10c9. Statutory Provident Fund, Section 10, subsection 11. Thus, Sukanya Samriddhi Yojana, Section 10, subsection 11a11. Recognized Provident Fund, Section 10, subsection 12. 12. National Pension System, Section 10, subsection 12a13. Approved Superannuation Fund, Section 10, subsection 13. 14. House Rent Allowance, Section 10, subsection 13a15. Special Allowances, Rule 2BB, read with Section 10, subsection 14. Leave Travel Concession, or LTC, means the exemption you get for the amount received from your employer for travel within India, for yourself and your family. Family includes your spouse, children, and dependent parents, brothers, and sisters. The key conditions are: the journey must be within India, foreign travel is not covered. The exemption is limited only to the actual travel fare, that means air, train, or bus tickets. Expenses like hotel stay, meals, or sightseeing are not exempt. For example, if your employer gives you 50,000 rupees for travel, but your actual ticket cost is 40,000, then only 40,000 will be exempt, and the remaining 10,000 will be taxable. Next, if a foreign citizen works or visits India for official purposes, certain types of income are exempt from tax. The exemptions apply in the following cases. First, if they are diplomats or staff of an embassy or consulate, their salary is fully exempt, based on a mutual agreement between India and their home country. Second, if they work for a foreign company that does not carry out business in India and their stay in India is 90 days or less, their salary is exempt. Third, if they are employed on a foreign ship and stay in India for 90 days or less, their income is exempt. Lastly, if they are foreign government employees undergoing training in India under an official program, their salary is also exempt. Next one, under exemptions under the head salaries is Indian government employee working abroad section 10 subsection 7. If an Indian government employee is posted to work outside India, all allowances and perquisites received for that foreign service are fully exempt from income tax. This means any additional payments or benefits provided to support their overseas assignment, such as housing or travel allowances, are completely tax-free. Death cum retirement gratuity section 10 subsection 10. Gratuity is a lump sum paid by an employer to an employee as a reward for long and continuous service, usually at retirement, resignation, death, or disablement. Government employees, for employees of the central or state government, or local authorities, gratuity received under the revised pension rules is fully exempt from tax. For example, if a government employee receives 12 lakh rupees as gratuity, the entire amount is tax-free. Employees covered by the Payment of Gratuity Act, 1972. For non-government employees whose employer is covered by the Gratuity Act, the exemption is limited to the least of 15 days' salary for each completed year of service, or part exceeding 6 months, 3,50,000 rupees, actual gratuity received. Other employees, not covered by the Gratuity Act, for private sector employees not covered by the Gratuity Act, exemption is the least of half month's average salary for each completed year of service, 3,50,000 rupees, actual gratuity received. Under Section 10 subsection 10, a commuted pension is the lump sum an employee receives in advance instead of receiving the full monthly pension after retirement. Government employees, for central, state, defense, or local authority employees, the entire commuted pension is fully exempt from tax. Non-government employees, for private or non-government employees, only a part of the commuted pension is exempt. If the employee also received gratuity, 1/3 of the full value of the commuted pension is exempt. If the employee did not receive gratuity, 1/2 of the full value of the commuted pension is exempt. Leave encashment. Leave encashment is the cash received by an employee for unused earned leave at the time of retirement. Government employees, the entire leave encashment amount is fully exempt from tax. Non-government employees, the exempt amount is limited to the least of the following three. Cash for the earned leave balance. 1,35,360 rupees, as specified by the government. The actual amount received by the employee. Retrenchment compensation is the amount received by a workman when they are laid off from service. Under Section 10(10)(b), this compensation is exempt from tax up to the least of the following. The amount specified under the Industrial Disputes Act. 50,000 rupees, whichever is lower. Section 10 subsection 10c provides tax exemption on voluntary retirement compensation, also called VRS. It applies to employees of public sector companies, private companies, local authorities, cooperative societies, universities, IITs, and certain management institutes. Both government and non-government employees can claim this benefit if their organization offers a VRS approved under Rule 2BA. The exemption is limited to the least of three amounts. First, last drawn salary multiplied by 3 and then by completed years of service, or last drawn salary multiplied by remaining months of service, whichever is higher. Second, 5 lakh rupees, which is the statutory limit. Third, the actual amount received on voluntary retirement. Under Section 10 subsection 11 of the Income Tax Act, the amount received from certain provident funds is fully exempt from income tax. This includes, first, a statutory provident fund set up under the Provident Fund Act, 1925. Second, any other provident fund established by the central government and notified in the Official Gazette as eligible for exemption. The Sukanya Samriddhi Yojana, or SSY, is a government-backed savings scheme for the girl child. It was launched under the Sukanya Samriddhi account rules in 2014 and is operated through post offices and banks under the Government Savings Bank Act of 1873. The scheme is fully exempt from income tax, meaning all contributions, interest earned, and maturity proceeds are tax-free. Next, a recognized provident fund, or RPF, is a retirement savings scheme where both the employee and employer contribute regularly. When an employee withdraws the accumulated balance, which includes contributions and interest, it can be exempt from tax if certain conditions are met. First, if the employee has completed at least 5 continuous years of service with the employer maintaining the RPF, the entire withdrawal is tax-free. Second, if the employee's service ends due to reasons beyond their control, such as ill health, closure of the employer's business, or any other unforeseen reason, the withdrawal remains exempt, even if service is less than 5 years. Third, if the employee changes jobs and transfers the balance to a new employer's RPF, the amount is not treated as withdrawal and remains exempt. In this case, the past service period is added to the new employer's service when calculating the 5-year condition. The National Pension System, or NPS, is a voluntary pension scheme regulated by the Pension Fund Regulatory and Development Authority. Both employees and employers can contribute to an NPS account. Under Section 10 subsection 12a, when an employee closes their NPS account or opts out of the scheme, the amount received is exempt from tax up to 60% of the total accumulated balance. Under Section 10 subsection 12b, during employment, if an employer makes a partial withdrawal from their NPS account, up to 25% of their own contributions can be withdrawn tax-free. Next, an approved superannuation fund is a retirement benefit fund created by an employer for employees. Payments from this fund are tax-free under certain conditions. The payment is fully exempt from tax if it is made on the death of the employee, or if the employee becomes incapacitated before retirement. It is also fully exempt when the employee retires at or after the specified age, or if employment is terminated due to incapacity. Refunds of contributions on the death of a beneficiary are fully exempt. If an employee leaves service before retirement, the refund of contributions is exempt only to the extent of contributions made before the Income Tax Act, 1961, and interest on them. Finally, if the fund is transferred to a National Pension System account under Section 80 CCD, the amount is fully exempt from tax. House Rent Allowance, or HRA, is an amount given by an employer to an employee to cover rental expenses if the employee lives in a rented house. HRA is partly exempt from tax under Section 10, 13a. The exemption is calculated as the least of 3 amounts. First, the excess of rent paid over 10% of salary. Second, 50% of salary for metro cities, or 40% for non-metro cities. Third, the actual HRA received from the employer. Whichever of these 3 amounts is the least will be exempt from tax. Special allowances under Section 10, 14, read with Rule 2BB, are allowances given to employees to meet expenses incurred for office duties. These allowances are exempt to the extent actually spent. The exemption is calculated as the lesser of the amount spent or the amount received. Examples of such allowances include travel allowances for tours or transfers, helper or assistant allowances, academic, research, or training allowances, uniform allowances, and conveyance allowances for performing duties, not for commuting. Allowances exempt up to a fixed limit. Certain allowances are exempt from tax up to a fixed limit, even if not fully spent. These include Composite Hill Compensatory Allowance, up to 300 rupees. In some notified areas, the limit ranges up to 1300 rupees. In Siachen, it can be 7000 rupees. Tribal Area Allowance, 200 rupees in specified states. Special compensatory allowances for border, remote, difficult, or disturbed areas, ranging from 200 to 1300 rupees depending on the location. Transport allowance for employees in transport services, up to 70% of allowance or 6,000 rupees, whichever is less. Children education allowance, 1,000 rupees per child for a maximum of 2 children. Hostel expenditure allowance, 300 rupees per child for a maximum of 2 children. Compensatory field area allowance, 1,300 rupees. Counter-insurgency allowance for armed forces, 1,300 rupees. Transport allowance for disabled employees, up to 1,600 rupees. Transport allowance for commuting to work, up to 800 rupees. Underground allowance for coal mine employees, up to 800 rupees. These fixed limits vary based on rules notified by the government.